problem.
Good afternoon and welcome to BizTech Asia's Asian Midday Market Watch on the 5th of June. It's a Wednesday. I'm Jeffrey Halley and I'm joined with my co-host today, Samantha Voon. And our guest today is a friend of the show we haven't seen for far too long, Tim Waterer, Chief Market Analyst at KCM Trade in Sydney. Tim, I believe you are in Singapore, but welcome to the show.
Thanks very much, Jeff. Yes, here in sunny Singapore. Good to see you again. And hello, Sam.
Good to know you.
Right, let's start off as we usually do and take a glance around Asian stock markets today, and then we'll get Tim's thoughts on those price movements. In Japan, the Nikkei 225 has fallen by 1.03%, by far and away the worst performer in the region today. Shanghai is 0.34% lower, but Hong Kong has actually managed to gain 0.44%. Down in Australia, the ASX 200 is also slightly higher, climbing 0.35%. Meanwhile, in South Korea, the Kospi has jumped by 1.14%. In Singapore, pretty quiet day, the STI climbing 0.25%. While in Kuala Lumpur, the KLSE is down just 0.12%. Tim, that's a pretty mixed day. Wall Street had a fairly innocuous close, the major indices climbing just a tiny bit. We are seeing some volatility in some markets here in Asia. What are your thoughts on today's movements?
Yeah, that's right, Jeff. I think we're seeing a bit of a ho-hum day across the Asian markets today after that lead from Wall Street. I think we're seeing some range-bound conditions. Obviously, we've got some key data coming up later in the week, so perhaps a little bit of risk being taken off the table midweek as the traders are just assessing some data that's coming out. Of course, I think the focus overall still very much on the interest rate picture and by extension, the inflation outlook. So I think that's still what's driving markets at the moment. But just some of the enthusiasm being reined in a little bit across the Asian markets today.
Okay, I guess we'll be probably talking about some data due out later this week, and I guess there's a bit of wait and see going on. Let's talk about one of the major stories that has happened this week and overnight in particular, and that is the India election, where Prime Minister Modi's party failed by an awfully long way to gain a majority in Parliament, in the India Parliament. We saw some huge volatility in particularly Indian stock markets yesterday. I think the Sensex was down over 8.5% at one stage intraday. Can you talk us through what's driving this volatility in India stock markets, and perhaps briefly your outlook now that the political landscape has changed quite substantially?
Sure. Yeah, I think certainly India, a big story in markets this week so far, that's for sure. So while the election results themselves were surprising, they went against some of what the exit polls were suggesting. I think the market reaction isn't surprising because we know that investors dislike uncertainty, and that's essentially what we got coming out of the election. I mean, we can cast our minds back to the 2016 US election, where we saw an adverse reaction from markets due to an unexpected election result. We're seeing something similar this week, as you alluded to there. The Nifty 50 down very heavily yesterday. A lot of that was driven actually by foreign investors closing positions, because that uncertainty does cast a cloud over India's at least short-term economic development. Of course, the economy still ticking along very nicely at 8.2% GDP. Not too many countries can say that at the moment. So I think demographically the picture still looks quite bright for India going forward, a growing consumer market. So I think the GDP outlook still looking pretty solid, but short term, yes, there's certainly some volatility and some questions. Of course, we're still waiting to see what the outcome of the election will be. But if Modi's government can't form that majority, then we could be looking at perhaps some roadblocks in terms of policy moving ahead, and that could have economic implications. So if they don't get the majority, we could see maybe a focus more towards welfare reform rather than infrastructure platforms. So short term, yeah, we could see perhaps some hiccups or road bumps for India, but longer term, the picture's still looking pretty bright, I think. But yeah, we're a little bit more stability on the Indian markets today and with the rupee. But yeah, once again, just relates back to that uncertainty. I think once we get a clearer picture of the outcome, we could see markets settle down a little bit more.
Sorry, guys. Audio is a bit. I have some problem with my audio now, so I might have missed some stuff that you guys have spoken about. But let's look at some data releases from Asia today. So at China, the Caixin service PMI rose 54, outperforming, while Australian GDP rose just 0.10 quarter on quarter. Contrasting data, what it is saying about the outlook for both economies?
Yeah, that's right, Sam. So the Caixin data came out today from China, better than expected. 54 and above is a solid reading. It contrasts with what we saw from the official government figures on Friday, where both the manufacturing and the non-manufacturing data came in lower than expected. Wasn't too bad, but not as strong as participants were hoping for. So still a mixed picture from China at the moment. You would have to say that on average, this year, 2024, the data from China has been looking a little bit stronger. In terms of the CPI, it's in positive territory. Some better figures in terms of the industrial production. So yeah, some better signs, but I'm not convinced they fully turned the corner yet. We are seeing some foreign investment starting to creep back into China, with things looking a little bit brighter. But I think we'll be wanting to see some further progress in terms of that youth unemployment, which still remains quite high at the moment. So in terms of the Australian economy, yeah, we had the GDP come in for Q1 2024 at a quite anemic 0.1% growth, which was less than the 0.2% of Q4 2023. And that was also the number that was expected. So this week GDP, and that's the only way to describe it really, it does put the RBA in something of a conundrum where they've got this very slow growth pattern happening, but yet CPI has been ticking higher according to the most recent figures there. So they're in a bit of a quandary, the RBA. I don't think they're in a position to start cutting rates at the moment with CPI edging higher. There's still a chance we could see a cut coming maybe around November this year, but that's far from a done deal. But I think what the weaker GDP figure today does is perhaps give the RBA some leeway to maybe transition slightly more towards a less hawkish stance at their upcoming meeting. So yeah, certainly not great figures from a growth perspective from Australia today.
But we can't use the word stagflation. Let's not think about that.
Can't mention it.
So let's turn to currency markets now. We had a weak JOLTS number overnight, JOLTS job openings number in the States overnight. We saw another rally in US dollar yields. What stood out to me was that the US dollar also fell once again, and it's been under consistent pressure this week. Even the Japanese yen has gained versus the US dollar overnight. What is your outlook for the US dollar? Are we finally seeing the end of this long US dollar rally in sight?
Yes, it's been certainly a rocky week for the US dollar. Really on the back of that tamer core PCE last week, then some softer manufacturing readings as well. So the dollar index was, quite elevated around that 105 level a week ago. Now it's just keeping its head above that 104 level. I'm not particularly bearish on the USD. I mean, I think there's still a constructive outlook for the dollar, because while the Fed are expected to cut it sometime this year, there certainly won't be all alone in that regard. I think we could be seeing the ECB moving this week and some other central banks as well. So I'm not in the camp that expects a large USD depreciation from here. I still think the US economy is still looking attractive versus a number of its peers right now. And while, yes, US yields have fallen this week, and that's pulled the rug out from the dollar slightly, I'm not expecting steeper declines from here. A little bit of short-term volatility, yes, but I still think the USD will perform quite well, against its peers looking ahead. Based on where the US jobs market stands at the moment, based on where that inflation reading is at, which is still above where it is in Europe, for example. So I think a case could be made that US rates will be staying higher than in other regions, such as in Europe. So I think the yield play still favours the US dollar looking forward.
Tim, let's turn to oil prices. So it's plunged overnight despite the OPEC recent commitment to production quotas. What's driving the sell-off?
Yeah, oil, a very poor week. Looking at the charts, I think that it stems back to that OPEC Plus meeting. Quite surprisingly, the cartel, they outlined a plan for basically putting a stop to these voluntary cuts, which will be phased out over the course of a year, starting in Q3 of this year. So while they have announced an extension to, I guess, what you would call the group-wide level cuts, so they're happening, those voluntary cuts are being reined in. And I think that what that shows is there is maybe not a universal agreement amongst members about sort of, what the appropriate level of production is. So the net result is some supply will be added back to the oil market, and that's driven the price lower. And that's why we're seeing that WTI contract now trading around about that $73 mark versus $80 where it was not so long ago. So short-term outlook for oil, weaker, still a chance for a move higher, given the fact that we do have a number of conflicts going on around the globe at the moment. So it could still spike higher. A lot will depend, I think, on what story emanates from the Northern Hemisphere summer holiday period. If demand is strong there, we could see oil creeping higher again. But certainly near term, based on the back of that surprising OPEC Plus announcement, yeah, oil in the doldrums, we might say.
Okay, with that in mind then, while we're staying in the commodity space, what are your thoughts on gold? It's still managing to remain very comfortably, a long way above the $2,000 an ounce mark. It's been, and I know it is supposedly an inflation hedge, but if inflation's moving a bit lower now, is that still a factor in gold's rally? Is it a risk hedge? I mean, what do you believe is driving the solidity in gold prices? It's disappointed rampant bull markets before. I consider a bit of a heartbreaker of a commodity. What are your thoughts on gold from here?
Yeah, that's right. Another story of 2024 has been this historic run of the gold market to record highs. So in terms of this week's activity, it's been solid, if not spectacular for gold. It's really consolidating around these current levels, awaiting a fresh impetus to move it higher. In terms of what's been the driving force for gold, I mean, I think a lot of it is central bank demand from the likes of China and India. Part of it has also been retail investors positioning for when we do eventually get that lower interest rate environment. So, I mean, it's quite impressive that gold has hit these record highs despite losing out in terms of an opportunity cost at the moment. So it's gone against the grain a little bit there. And of course, I mentioned earlier, we do have, I guess, two prominent conflicts going on around the globe at the moment. So that's keeping some safe haven bids happening for gold. So yeah, it's come off the boil a little bit, but I think, the outlook still looks constructive. I still believe that 2,500 is still a viable near-term price target for the precious metal. But I think that would be dependent on the US dollar losing a bit more steam from here, and some of the wind being taken out of the sails of the treasury market. We've seen that happen this week, but I think that would need to happen to a larger extent to enable gold to hit fresh record highs.
Okay, well, that leads me into my final question for you, Tim, and that's, nobody can complain about the lack of volatility this week, but we need to talk about the elephant in the room, because I believe nerves around that is what is driving a lot of the volatility this week. And this is Friday's US non-farm payrolls data print. What are your thoughts running into that print?
Yes, that's right. NFP always, circled it in red for investors and traders around the world every month, because it is a big market mover traditionally. So if we look at what's happened so far with non-farm payrolls this year, so we've seen 5 releases, including the December figures. And of those 5, 4 of those have surprised to the upside. So there has been a tendency, even going back the past 2 years, for non-farm payrolls to produce an upside beat. But the last time round, it missed expectations. Now, whether that is a sign that the tide is starting to turn remains to be seen. And I guess, we'll see what happens this week. If we see another miss to the downside, then, yeah, it could be a sign that this higher interest rate environment, which has been happening for a while now in the US, is starting to take a toll on the long resilient jobs market. So I guess in short, if we do see a softer print, I think we could see expectations for a potential September cut from the Fed increase. and that could see some sting taken out of the US dollar, could move gold higher, vice versa. If we see an NFP print sort of nudging 200K, right now expectations for 185,000 jobs to have been created. But if we see something around 200, it could show that last month's miss was a blip and that the jobs market remains ultra tight. So yeah, a lot hinging on that. I do think we'll see, a spike in volatility around that NFP release, as tends to be the case. But as you say, I mean, we haven't been short of volatility so far this week anyway. So a lot to play out in markets between now and the end of the week.
Right, well, this has been a bumper show, Tim. I think we've covered just about everything off the top of my head. Thanks so much for your time today.
Thanks, Jeff. Thanks, Sam. Always a pleasure to come on and chat, and enjoy the rest of your week, and I'll see you next time. Yeah,
we hope to have you back very soon. We've been speaking to Tim Waterer, Chief Market Analyst at KCM Trade in Australia. You've been with Jeffrey Halley and Samantha Voon on BizTech's Asian Midday Market Watch. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also catch it with our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in today.